You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Option Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. And the Wide World of Options radio show is one of the ways the message is spread. OIC also offers a variety of other resources to those interested in learning more about options, including webinars, podcasts, and live events. For more information, check out optionseducation.org. Now, here's your host, OIC's Director of Individual Investor Education, Joe Burgoyne.
The Options Industry Council is an industry resource funded by OCC, and in today's industry happenings, I'd like to focus on the OCC. The OCC has rebranded itself. Now, to many of you, the response may be, who cares, or who's the OCC? Well, I believe it's important to understand the role OCC plays in our financial services industry. As the foundation for secure markets, OCC delivers risk management, clearing, and settlement services to the exchange-listed options market. As a SIFMU, now a SIFMU is a systematically important financial market utility. The OCC provides financial stability for market participants, investors, and the economy. Now, the financial guarantee and central counterparty role also extend beyond the listed options market to the over-the-counter listed options market, financial and commodity futures, security futures, and securities lending. It's that financial guarantee and central counterparty role that are why the OCC is the foundation for secure markets. A few stats before we go here. The listed options industry is now comprised of over 4,200 underlying products and over 950,000 strike prices. That's a lot of risk management demand, and OCC delivers for all of us each and every day. That's today's industry happenings.
Now, let's meet the movers and shakers from the world of options in Profiles and Perspectives.
Joining us today on Profiles and Perspectives is Lisamarie Lukas, Vice President of Corporate Communications at the OCC. Welcome, Lisamarie.
Hi, Joe. Thanks for having me. Really appreciate it. It's a pleasure to be with you guys today.
Well, thanks for making the time. And I think, how about if, before I focus on you, how about if we just start by talking to our audience a little bit about OCC? Would you tell us about the OCC?
I would be happy to. OCC, also known as the Options Clearing Corporation, was founded in 1973. We are the world's largest equity clearing, derivatives clearing organization, and really the only central counterparty providing clearing and settlement services to 19 exchanges and trading platforms for options, financial futures, and security lending transactions.
That sounds awful important.
It is really important. You know, we were designated by the U.S. Treasury's Financial Stability Oversight Council as a systemically important financial market utility, and this really reflects OCC's critical role within the U.S. financial markets infrastructure. The council itself, which many of you may know, was established by the Dodd-Frank Wall Street Reform and the Consumer Protection Act. And the council really provides comprehensive monitoring of the stability of our nation's financial system.
Well, honestly, and I do want to get back to you for sure. In fact, how about if I do that now? Before we get even further into the role and responsibility of OCC, talk to us a little bit about yourself. How did you come to join OCC, and maybe a little bit about your background in the industry?
Sure. So I am a 20-year-plus veteran of corporate communications and marketing discipline, a lifelong Chicagoan, so I've known about OCC since its founding in 1973. And I was really attracted to this role, not only because the people I knew who were working here in the industry, I really respected those executives and their leadership in really trying to build a community of intellectual curiosity and problem solving and really shaping the thought leadership for the next generation of leaders in the financial markets and also in risk management. So I was very attracted to the role because of that.
Well, certainly I've been lucky enough to be part of OCC for coming up on 10 years now. So I've seen, the evolution. I've seen some of the change. Well, I've seen, all of the changes firsthand. And, you were absolutely instrumental in this whole idea of rebranding at the OCC. Could you talk about maybe why we did that and why it's important?
Sure, of course. Really at OCC, when I started, there was a conversation about 2-3 years ago about our new brand identity. And what we really worked towards was to align this new brand identity that we recently unveiled, because OCC is an increasingly visible in its work as a SIFMU, so the systemically important financial market utility. We're an increasingly influential thought leader, and we've really been a steward of the U.S. exchange-listed options industry for more than 45 years. I think since its inception, we've promoted resiliency and innovation among market participants because we do provide high-quality and efficient clearing and resettlement services. And this focus on the brand, we really wanted to talk about being an important market utility, sound risk management, increased policy advocacy, and the compelling market educational content that we provide through the Options Industry Council. And this is why we decided to have a new brand. It's really been exciting for OCC because for the past 45 years, we've really focused on building a strong foundation and a reputation for delivering risk management practices and capital efficiency to the markets we served. So this is a good opportunity for us to step back, think about who we were as an organization and where we're going, and really build an exciting future with more than 740 colleagues that we currently have at OCC today.
740. Well, as I said, I've been on the front lines, part of this for close to 10 years, and there's no way we had anywhere near 740 employees, say, 2, 3, 4 years ago. So why the increase in heads here at OCC?
OCC is really focused on, and its leadership is focused on expanding the team because of the demands of risk management and sound practices and principles. We've really grown and expanded our risk management disciplines, including enterprise risk management and financial risk management. And we're deeply focused on providing thought leadership to the marketplace as well. So right now we have offices in Chicago, Dallas, and Washington, D.C. And we're increasingly growing. There's a lot of demand to get in the door at OCC. And Joe, as you and I both know, it's really been a great place to work.
Indeed it is, and will continue to be, I'm sure. that whole aspect of risk management that you're talking about. And then also you've mentioned a few times the SIFMU designation. I know when I'm lucky enough to get out there and present, I frequently talk about, OCC as the differentiator in the marketplace because of, the guarantees that we offer. And really that gets back to, this risk management aspect as well for the entire industry. Could you just maybe once again, Lisamarie, speak to a little bit the importance of this SIFMU designation, just so our listeners get a clear understanding of what that means?
Sure. Of course, I'd be happy to. So the OCC was designated as a SIFMU after and following Dodd-Frank reform and the Consumer Protection Act. And really what it says to the industry, to the marketplaces that we serve, is that we have a critical role within the U.S. financial markets infrastructure. I mean, what we do is we manage risk for those involved in options trading by being the buyer to every seller and the seller to every buyer. And this provides stability and market integrity and helps us really ensure confidence in the financial markets and the broader economy.
I mean, that is one heck of a responsibility. And, as you said earlier, I think that's a big part of the reason why we've gone from, a couple hundred employees to north of 740 and still continuing to grow at this point.
It is. And Joe, another thing I want to mention there is I think we're also growing because we're really and you know this very well with your team, been the leading provider of online and unbiased educational content for the users of the options market. So, whether it's individual investors who are only the basics or knowledgeable investors who want to use more complex trading strategies, I think between building the confidence and stability in the financial markets and the education for the future, that's really why we internally, and I think we're being increasingly recognized as a foundation for secure markets.
Well, it really is, just a true pleasure to be able to be part of, the OIC team and then, OCC as well. Any closing thoughts, do you think, Lisamarie, before we wrap it up?
Well, Joe, certainly I want to recognize the work that you and your team do. Obviously, for 25 years, you have helped OCC grow in its reputation, and that's really expanded and helped brand our identity. So that's been incredibly important. And I just want to give a shout out to you and the team for that. Obviously, optionseducation.org is where everyone can go to learn more about OIC and the Options Industry Council. But I also want to encourage people who are interested in learning more about OCC to visit us at theocc.com. And if you are interested in a career at the Options Clearing Corporation, OCC, please do take a look at our website. We are particularly looking for leaders in risk management from a variety and range of disciplines. So it's really been a great place to work. I encourage everyone who is interested in following through to give us a look.
Well, thank you for the shout out. Now, I want to go back to that last thing you said, because I know that we do have a number of opportunities. Where could potential candidates find a list of those opportunities?
Go to the Options Clearing Corporation website. It's theocc.com and click under careers, and you'll find great information about the organization. You'll learn what it's like to work at the organization. You'll see there's a great video from our executive chairman and CEO, Craig Donahue, that talks a little bit about our history and where we're headed. And certainly there is a link to all of our jobs. And we are certainly a growing organization. The demand is there for a great skill set. It's a great community of people to work with every single day, and it's just a pleasure to serve.
Well, Lisamarie, thanks so much for joining us today, offering your, certainly well-rounded insights into the OCC and its culture. And, we look forward to expanding this pie going forward together. Thanks again.
Thanks again, Joe. Appreciate the time.
It's time to break down the latest option strategies. That means it's time for Strategy Spotlight.
Joining us today on Strategy Spotlight is my colleague, Ed Modla. Welcome, Ed.
Thanks, Joe. Glad to be here.
How about if you tell us about your background in the industry, maybe how you landed at OCC and, what's your role at OCC?
Sure. We can start there. I've been in a few different places within the industry. Started on the trading floors in 1997 out in Chicago, and that's where I learned the options business, trading in the pits at the CBOE, also at the Mercantile Exchange out there in Chicago, and some time in New York at the Amex. So I was a trader on the floors and then, of course, on the screens for quite a number of years after that. Got into the brokerage side of the business, working with futures and commodities markets for quite some time, and eventually landed my way with OCC, the Options Clearing Corporation, managing their investor services team, which is more like a resource center for exchanges and trading firms and advisors and individual investors. They ask all sorts of questions to us every day. So now in the education and support side of the industry, and I'm enjoying myself managing a small team there at OCC and participating in a lot of the educational efforts of the Options Industry Council.
Indeed, you do, and you and I get to work together a lot, and I certainly enjoy that, Ed. So,
yeah,
fantastic.
It's a great pleasure.
And starting on the floor back in those late '90s, we had some rock and rolling markets back then too. I'm sure there was.
I tell you, we absolutely did, and I wish I had a few more years back then. I often tell people I started in the business just a few years too late. I was able to get in when it was very good down there in the late '90s at the turn of the century, but it didn't last too much longer after that.
Well, the markets certainly have matured, that's for sure. But before we get into our strategy for the day, you're at OCC. We're both actually at OCC. How about if you tell our listeners exactly something about OCC, maybe the important industry function that they perform?
Sure. Yeah, OCC is vital to the industry. So by definition, OCC is the world's largest equity derivatives clearing organization. Ultimately, when a transaction occurs on an exchange between a buyer and a seller of a listed options contract, OCC then severs the tie between the buyer and seller and takes the opposite side of each, effectively the seller to the buyer and the buyer to the seller. So severing that tie is very important. OCC then manages the risk of each side to make sure that exercise and assignment obligations can be fulfilled. It's incredibly important. Without this form of severing the tie and clearing the option in this way, the options industry just simply couldn't work and couldn't function in the organized way that it does today.
Good description. And for your listeners, I mean, as Ed said, it's a critical function that OCC handles each day, and it frankly is, an aspect that sets the listed options market apart, both that risk management capacity as well as the transparency that goes along with each trade. So thanks for that, Ed.
Yep, true.
Why don't we, move into the whole idea of the strategy that you wanted to talk about today, stock repair. Why'd you pick stock repair?
I feel a lot of questions on a regular basis from trading firms and investors, and stock repair just does not come up too often. And, there are certainly reasons why people use listed options to generate income, to enhance the returns in their portfolio, but risk management is at the forefront there as well. And this strategy is all about managing risk and managing losses. The construction of the strategy we'll get into in a little bit. But I think because it's pieced together at two different times, it's not a strategy that you execute all at once. There's a precondition and then a further follow-up to manage the position to put it together. I think because of that dynamic, it sort of falls off the radar when you see a list of strategies or when people talk about different types of option strategies to manage risk. Stock repair just doesn't seem to be there as often. So I wanted to emphasize that one today and at least go through how it works for your listeners.
Well, fabulous. And so you listeners, hopefully Ed is bringing something new to the table for you today. How about if I almost start at the back end? What's the goal of the stock repair strategy?
So within managing risk, getting a little deeper here, the goal of the strategy is to manage a losing stock position. A position that you've initiated, buying shares of stock, it's moved against you, and now you're looking to manage that loss, ultimately to try to break even. The strict construction of the trade and the strategy is that you are lowering your break-even point and trying to get out of a losing trade without taking a loss, to get back to break even, and to do so at a lower price point than just simply where you bought the shares of stock. And then the other very key component to the strategy is that you're executing this in such a way where you're not spending more money. You're not doubling down and buying more shares, or you're not net paying for options in order to accomplish this without adding any cost to the trade. You're able to lower your break-even point and try and get out of the bad trade without taking a loss.
Okay, I like the sound of this. A couple questions come to mind. First one I want to ask is, how about if maybe you go through an example or two so we can get to understand exactly how this works?
Yeah, I think that's probably the best way to go through it. A hypothetical example. Let's say you had purchased 100 shares at $75 a share, and you've held onto the stock for a while. It hasn't gone very well, and now the shares are trading down at 65. Well, if you just hold on to those shares, of course, you need to have a nice move to the upside, $10 worth to get back to your break even at 75. You could also consider exiting the position. That's always something that you might want to consider when a position has moved south on you like that. But if you're bullish, you think the stock might be due for a bounce, just not back all the way up to 75, then you can execute this stock repair approach. That would entail buying an at-the-money call option. In this case, that would be the 65 strike price call, and then going just out of the money, roughly halfway in between your entry point on the shares and where the stock currently is, that would be, say, $70, and selling 2 call options at that 70 strike. So if you think about how this is constructed, you've effectively given yourself the right to double up on your share position. That's what owning that 65 call gives you the right to do. The 70 calls that you sold were a way to pay for the purchase of the 65 call option that you bought. Now, there's also a negative there as well. The 70 calls obligate you to exit the entire position. So if the stock rallies up into the high 70s or goes up to 80, you don't get to participate there. But you've executed this trade at zero cost, ideally, and now you have the opportunity to buy more shares. I'm going to zero in on that net cost or even money aspect. Of course, in a real live account, things are probably not going to work out as cleanly and as crisply as I just described with numbers. So you may have to look around at different strike prices and look at option premium amounts. But generally speaking, as you go out further in time, the difference between the option premium amounts are going to shrink. They're going to get closer together. And what that means is if you go out far enough, you may be able to execute this strategy for a credit. If you go very close to expiration, very near term, you may have to incur a small debit in order to execute the strategy. Now, it's not always a crystal clear decision. People might think, well, I'll just go out further in time and always do this for a credit. You certainly could do that. There's a benefit to that. But keep in mind, the longer you go out in time, a couple things happen. First of all, your risk is in the shares of stock. We've lowered our break-even point, but we didn't get rid of the risk of owning 100 shares. That is still there. The risk is not added to. The options didn't create more risk, but owning 100 shares still has risk, and going out further in time means the stock has more time to go south even further below 65 and incur losses there. But also you have to consider going out further in time means you might be in this trade for longer, and that's the second point. Your capital is already tied up in those shares, and it will be continued to be tied up for maybe a longer period of time if you go out further in time. So that's a very important consideration as you put the trade together. But back to how it's constructed, you buy one at-the-money call option, you sell 2 call options roughly halfway in between your entry point on the shares of stock and where the stock currently is. And if you get back to that 70 level, that 70 price, now you're looking at your break-even point instead of going all the way back up to 75. In a nutshell, that's how it works.
Okay, really well described there, Ed. So just to clarify, and I think you stated this early on in terms of the goal of stock repair, it's not to make money in a position that's going bad. It's the ability to break even at a lower point in the stock. Is that correct?
Right. Yeah, that's absolutely correct. And that's a very important point to clarify, because if the stock does continue to run much higher, you don't get to participate.
Okay. Gotcha. So A couple other things come to mind. All right, so we know we can't make money on the position. We're just lowering our break even, and then if we want to initiate another, potentially profitable position, we'd have to do that on top of the stock repair strategy.
Right.
You may have addressed this a little bit talking about options further out in time, but does volatility become a factor in this strategy? Implied volatility?
Well, it's a good question. It could become a factor. And of course, options investors are always considering what their volatility exposure is with any strategy they do. Here, when you look at, say, the vega of each option, what you'll likely find is the long volatility exposure you have by buying the at-the-money call is mostly, if not entirely, offset by the short vega of the two out-of-the-money calls that you sold. Now, that can change as the stock moves and the volatility of each option slide around the volatility skew. That dynamic could change. But at the onset of the strategy, upon its construction, I would expect that the net volatility exposure would be muted and very little to none.
Okay. You referenced really the effective use of capital. So we've got stock repair. I mean, is this, how do you make that decision between just getting out, freeing up your capital, and then getting into a position like stock repair, really just trying to rescue a position that's gone bad? Any insights into that?
Yeah, and this is where it gets really interesting, and we have to maybe get into a little bit more of market psychology. I've always said that the most difficult trade to make is the closing transaction on a losing investment. It's almost human nature for investors to want to stick into a trade and see it through and hope it turns around. But when you start to hope, that's when things may start to get even worse. So once you have that position, that precondition of this strategy where the stock has moved against you, it's trading at lower levels, this is where investors just need to be honest with themselves and evaluate where the stock is going. So this is the difference between what the stock has done in the past and where it's going in the future. We know it's performed poorly, and we're sitting on a losing trade. Now we have to be honest and ask ourselves, what's going to happen in the near term? Is it going to go even lower? Well, if that's the case, then as you suggested, maybe getting out of the position is the best way to go. Stock repair is not going to help you if the stock continues to go lower. But if you truly believe that the stock's going to bounce, it just may not get back up into the mid to high 70s, then stock repair fits that perfectly because it allows you to get out of the trade quicker at a lower price. But again, it has to be consistent with your market forecast. So my guidance or my insight into that is be honest with your market opinion. Don't hope for the stock to go somewhere, but believe it's going somewhere, and then construct the position that fits your market analysis.
Okay, don't hope. You know the old adage from the floor, sell hope.
That's exactly right.
Well, you laid this out very, very clearly, Ed. Probably a lot of our listeners maybe aren't too familiar with the stock repair strategy. So thanks for talking about it today. Any closing thoughts for our listeners?
Joe, I'll just close with this. For those listeners who are very familiar with our website, optionseducation.org, those listeners know that the strategies section on our website is very important, and it has a lot of good information there. So keep your eyes open for stock repair to pop up there. I think we're gonna work on something and put something up on our website very soon that involves stock repair in a description. And then feel free to reach out to us by email if you have any questions about that. So check out the website and look for something on stock repair to pop up there in the near future.
And how can listeners reach out to you via email at you and Bill and Mark?
Right. So our investor services team can answer any options-related questions without, of course, providing advice or opinions. Our email address is investorservices@theocc.com. And anybody can just send us out questions about a strategy or about something they're seeing on the Options Industry Council website. Send us an email. Again, it's investorservices@theocc.com, and we'll be glad to help you out as best we can.
Fantastic, Ed. I appreciate you joining us today on Strategy Spotlight. Always a pleasure to talk to you. Thank you.
My pleasure, Joe. Thank you.
Next, let's upgrade your options toolbox with cutting-edge trading platforms, devices, and information. Let's talk about tools, resources, and good reads.
Now, a really fabulous resource that I've mentioned maybe once before, but certainly not near often enough, is the OCC's Investor Services Desk. 5 days a week, my colleagues, Ed, Bill, and Mark, are available to answer each and every one of your option questions. You can reach them via email at options@theocc.com. That's options@theocc.com. These guys really know the business. Don't hesitate to contact them. Again, you'll find them at options@theocc.com. Ed, Bill, and Mark really enjoyed hearing from investors, so be sure to reach out to them. Finally, I'd like to make you aware of Dr. Alan Ellman's book, The Complete Encyclopedia for Covered Call Writing. Alan loves what he does, and generating income with options is what he does. So that's Alan Ellman's The Complete Encyclopedia for Covered Call Writing. Thanks for joining us today on Tools, Resources, and Good Reads.
Ready for a little nostalgia? It's time to take a look back.
We're continuing to respond to listener questions in our Looking Back segment. Today we'll address 3 questions. Lincoln offers, my go-to option strategy is to sell cash-secured puts on stocks that I want to buy and get paid if the stock doesn't expire below my short strike. If I do get assigned and take delivery of the stock, I eventually trade out of it by using a covered call. What do you think of this strategy? Savvy or stupid? Well, Lincoln, savvy is my response. You start clearly by doing homework on stocks you want to own, and as you say, either get paid to wait for the stock to drop to your strike price or get assigned, meaning take delivery of the stock and then you roll that into another income-generating strategy with the covered call. I like the approach a great deal, frankly. Our second question comes from KBX32. He asks, what is the cheapest way to hedge my portfolio with options? Well, KBX, you've asked a lot in a seemingly straightforward question. My response is there is no easy answer for the cheapest way to hedge the portfolio. One potentially inexpensive way to protect your portfolio would be a ratio put spread, also known as a back spread. There is risk in this position, potentially a lot of risk, depending on the price at expiration. But the general idea here is to sell fewer, more expensive puts and buy more, less expensive out of the money puts, financed by the ones you've sold. Net cost can be minimal. You can even do for a credit, but beware. Expiration levels are key, and there is risk in this type of position. Now, another portfolio hedge approach could be vertical put spreads, but these certainly do come with a cost, sometimes a substantial one. And our third question today, it's actually a comment and a question, comes from Giddy F. Sell in May and go away. What options strategy benefits from the profound market malaise that occurs over the summer? Well, Giddy F, I'm personally not a believer in the sell in May and go away adage, but as far as option strategies for a sideways or dull market, I'd consider the iron butterfly, the iron condor, as well as calendar spreads. There are others, of course, but I wanted to offer strategies that have defined risk. I hope you'll investigate them. So there are questions for today. As always, thank you. Keep them coming. And thanks for joining us on today's Looking Back.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email Joe Burgoyne at options@theocc.com or visit optionseducation.org and chat with Investor Services. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu and Instagram at options education, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.